Welcome to Market Week in Review for the week ending January 14th, 2022. I'm Chris Kyle, and today I'm joined by Chief Investment Strategist Paul Eidelman. Paul, I hope all is well as we continue to ease our way into the new year.
Yeah, I'm doing well. How are you, Chris?
Doing well, thanks. It hasn't rained for the last 24 hours, so I think we're heading in the right direction.
Yep.
So looking back on this past week, there's two items that clearly stand out. You have December inflation data and an elevated level of market volatility. So starting with the former, consumer price index CPI rose 7% for 2021 following December's release. Certainly not ideal for consumers and policymakers alike. So what can we anticipate over the next 12, 18 months, especially as it relates to decisions from the Federal Reserve?
Sure. So, starting with the inflation data, the numbers were really red hot in December. On a headline basis, we're looking at US inflation of around 7%, which is obviously way above the Fed's target. And even on a core measure, which sort of strips out the volatile food and energy categories, we have 5.5% core inflation in the US. So both of those numbers are really strong. I think the really important thing, though, for financial markets is they were expected. Most economists were looking for strength this month, and fixed income markets kind of yawned at the inflation data this week. We kind of coming into this, seen a sharp rise in U.S. Treasury yields year to date from call it 1.5% on the U.S. 10-year to close to 1.75% today. But there wasn't that much volatility right around the announcement itself, which kind of shows it was expected and priced. Under the hood of it, a lot of the inflation was from the same old categories that we've been talking about for several months. We're seeing a lot of strength in consumer goods prices and durable goods prices in particular, because that's where demand has been concentrated as people have been stuck at home. And it's also where supply chain issues are their most intense. And then also some strength in inflation from shelter and housing, given the housing market has also been very strong in the United States. I'd say the one encouraging thing within the inflation report, which is important for the medium term outlook, is we're not yet seeing a, a lot of evidence that the services sector and services inflation is accelerating. If we were to see that, it would be indicative that high wages are starting to bleed into higher prices in the broader economy. And so far, that kind of component of the inflation outlook remains firmly intact. Well, and I think the Fed has taken notice of higher inflation as well. They've pivoted pretty hard in just the last month or two to emphasize more of a risk management approach around their monetary policy strategy. And what that really means is they see some desire to hike interest rates sooner to give them the optionality to hike more should inflation stay sticky at high levels for longer than they're currently expecting. And so what we're hearing from them right now is, I think, quite clearly a desire to raise interest rates sooner, probably at the upcoming March FOMC meeting, with a reasonable baseline being that they'll continue to hike interest rates once a quarter thereafter. But that's by no means a promise. It's going to depend a lot on what actually happens to economic growth and inflation in the year ahead. And there's obviously some risks out there around what happens with the Omicron COVID variant and the very distinct possibility that inflation rates could decelerate pretty sharply in the second half of the year. So yeah, I think bottom line, inflation's really strong right now, and the Fed's paying attention to it and talking about pulling forward the timing of their rate hikes.
Well, while there's other factors at hand, intimately tied to the interest rate conversation is the market volatility we're experiencing. The US, growthier parts of the market, those seem most rattled, while major international indices are faring a little bit better. What are you seeing in terms of meaningful changes with respect to sentiment, or maybe where some of investors are looking to make changes?
Well, yeah, I think with this pivot from the Fed and with US and global interest rates rising so far this year in 2022, that's driven a pretty strong style rotation within the equity market globally. As a reminder, growth securities tend to be more sensitive to interest rates because investors are pricing cash flows far out into the future. So higher interest rates punish the valuations of growth relative to value. And so with the Fed kind of guiding higher interest rates, that's hurt growth and benefited value. And the sort of magnitude of that rotation has been quite large. So year to date, we're looking at globally an outperformance of value versus growth of almost 700 basis points so far this year, which is um, really quite strong. We do think, in terms of a baseline view, there's some potential for this to continue, even with the recent outperformance and better performance since the vaccines were released. The value style is still trading pretty cheap relative to historical norms, and as a more cyclical factor, given we're looking for a year of above trend growth, is also supported there in terms of the potential for better corporate profitability. So, yeah, frankly, really strong style performance so far, with an expectation that it can continue, even though maybe some of the big gains are now starting to materialize in the rearview mirror.
Well, I think we'll all have some time, maybe these next few days, to catch our breath from what the markets are doing, given U.S. markets are closed on Monday. But that said, as always, thanks for taking the time this morning, Paul. And to all of our listeners, stay safe and healthy out there.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.